Hi there, my name is Chris Can with Aspermont and MiningNews.net, and we're here at Mining News Select in Perth, and with me I have David Franklyn with Argonaut. Welcome, David.
Thanks, Chris.
We've talked previously about how difficult it is for especially the retail investor, but investors in general, to work through a lot of the issues with junior mining companies, sorting the wheat from the chaff, so to speak. I'm really keen today to get your view on the methodology behind how you make those decisions.
Yeah, thanks, Chris. Look, investing in small resources is dangerous business, right? So, and particularly as a fund manager, where to have a meaningful investment in a company, you need to take a decent sized position. And so what we found through experience is once you're in, it's very hard to get out, right? So you want to make sure that when you make a commitment to invest in a company that's relatively small and early stage, that you're really comfortable with what it's doing. And so we've developed a checklist. We go through it every time. I've got it here with me, and I thought that would be a simple way to kind of highlight that. So I'll run through them. So the first is location. So isn't an established mining province? And it's really important, you know, because if you're investing in a project in Mali, how is the market going to rate that? Notwithstanding the geopolitical risk of being there, but the market's always going to discount you for it. Geopolitical risk, do you want to invest in Ecuador where perhaps there's some political issues? Infrastructure, so Malawi, for example, looks they've got some great resources but lacking in infrastructure. So you got to be careful about location and how the market will rate that location. The second is, does it have the ability to be a significant scale asset, right? So you're making a big commitment to invest, you're doing a lot of work, and it might be because you like the commodity, but if it can't be a decent scale asset, then you probably don't want to bother about it. So scale is also important. An example of that is in lithium. We probably typically look for 100 million tonnes at, you know, between 1 and 1.4% sort of lithium in hard rock as kind of a benchmark. Outside that, you know, you're not quite getting to the scale you want to get to. ESG considerations are increasingly important and increasingly critical. As I touched on, you know, environmental impact, we're seeing, for example, nickel production expand rapidly out of Indonesia, but do you want exposure there given what's happening environmentally? If you look at social factors again, do you want to invest in the Democratic Republic of Congo and how some of that mining takes place, or Ecuador where there's also some social issues. And governance. Governance is always a factor because it reflects on management and management capability. So recently in Australia, we saw Boss Energy, the MD and some of the directors selling down a significant stake. You know, that caused some concerns. If you look at NextGen, which is also in the uranium space, you saw them do a capital raise and then announce a couple of days later they bought a whole lot of physical uranium, which in itself isn't that bad. The problem was they didn't tell the market they were going to do it. So it came as a surprise for new investors coming in. So, you know, all those factors you've got to consider because they're a factor in how the market will rate them, and it's an insight into the management capability. Is it a mainstream commodity? So do you want to invest in niobium or titanium? Or are you better off investing in copper and iron ore and commodities which the market is familiar with and again will apply a better rating to? Management competency, often that's backward looking, right? So where possible, you back people that have a good track record. The added benefit of that is they're going to be able to raise money easier and they're probably going to be able to raise it at a higher price, which in small mining companies where there's really two key drivers. One is the quality of the asset and two is how much capital they need to raise and what price it is. It's a fundamental issue. External validation. So who's on their register? Who are they partnered with? Who have they got off-takes with? Gives you a good insight into how the project is being assessed by other parties, which is always good. In mining, there's a lot of things you can't control. You can't control the commodity price and you can't control the exchange rate. But what you can assess and control in some respect is where it sits on the cost curve. So it's fundamental to understand the cost and the cost of production of the project if and when it gets up. Balance sheet strength, the last thing you want to do is see a small resource company with debt. You know, it's hard enough getting through with with a strong balance sheet. So if it's got debt, we don't want to know about it. And if it's got less than 12 months cash, then we'll probably wait if we like it and participate in a capital raise rather than buy it straight away. And then finally is the reliance on China. So the world is separating in between sort of the West and the rest. And if you're in a commodity that's highly reliant on demand or supply from China, then you need to be careful. So that's just a bit of a snapshot, just gives you a bit of feel for the things we go through, and helps us rank the projects that we want to back.
When you're looking at the mix and you're putting it together before you make a decision, David, is it a case of meeting thresholds for each of those categories? Or if you're particularly strong in the asset, can you be weaker in management, but some of the other criteria you mentioned? Yeah,
well, it's a good point. It's a wish list. Very seldom will you tick every box, right? So then it's kind of an assessment of does the value that I can buy it at today justify the risk and the subjective assessment on some of those criteria.
Yeah. David, you were at MiningNews Select Perth last year. Thank you for coming back this year. It's great to have you. Yeah. What's your impression been so far for the 2024 iteration?
Yeah, look, it's a great conference. There's a lot of technical expertise that we can pick up and a lot of good new ideas. And we're always keen and willing to listen to the stories, and you get a good selection here. So we'll be back next year.
You've sat on a panel for the energy transition. There's been a lot of other content rattling throughout the day, including keynotes from Rick Rule and John Ford. Have there been any particular takeaways for you from day one?
Yeah, look, I mean, I think the last 12 months has been a difficult time for most commodities, right? And I think what's really encouraging is you've got a big turnout and there's a lot of enthusiasm. And I think if you take a view of what's going to happen in the next 12 or 24 months, I think you've got to be pretty enthusiastic about the value that's out there and the opportunities to make money.
Thanks for taking the time to speak to us, David.
Cheers. Thanks, Chris.